Just when it seems that the housing market could not stretch any further into the realm of pricey, it has astonishingly expanded its frontiers by an additional $2 trillion. This leap comes from a time where higher interest rates would typically dampen the market's enthusiasm, and affordability has never been more challenging. The latest analysis from Redfin paints a vivid picture of this upward trajectory, highlighting a 5% surge in total value of homes across the United States. This increase is not minor and represents the most significant jump we've seen in almost a year. This development has ignited a flurry of speculations and inquiries amongst observers, essentially questioning around to what heights will the housing market prices soar to next, which regions are experiencing the most remarkable growth, and essentially emerging as hotbeds of real estate activity. And perhaps most intriguingly, the decision by Warren Buffett to exit the housing market entirely poses a perplexing puzzle. As a figure known to his acute investment foresight, Buffett's move may leave many wondering, is there an insight or a trend that he's identified that remains obscure to the broader public? The narrative around the housing market is evolving, marked by its increasing complexity and the discerning perspective of those navigating through its currents. As we get further into 2024, it's becoming increasingly clear that this year is poised to be a watershed moment for the housing market. Let's delve into the intricacies of the current landscape, its implications for various stakeholders, and the projections of the coming months, and strategic moves that could be advantageous, whether you're intending to buy, sell, or if you're simply observing the drama unfold from a distance. Before we navigate through the potential hurdles and opportunities that 2024 might present, it's crucial to establish a solid understanding of the housing market's present condition. This is going to form a basis of our insights and predictions for what lies ahead. Currently, the situation in the housing market can only be described as startling. As previously mentioned, Redfin's analysis has revealed the total value of the housing market has soared by $2 trillion over the last year alone. Looking at the broader picture, the market value has surged by an astonishing 13.3% over the past 2 years. This dramatic increase sets the stage for discussions and decisions that individuals involved in the housing market will have to face in 2024. You might be wondering, what's driving these remarkable changes in the housing market? It's the convergence of three distinct factors that together create a formidable force akin to the perfect storm. At the forefront of these is the pronounced shortage of homes available for sale. This scarcity, as some experts say, stems from homeowners' hesitancy to put their properties on the market. And the root of this reluctance, a significant portion of these individuals currently benefit from exceptionally low mortgage rates, a perk that they're not eager to relinquish. To put this into perspective, according to a report by Goldman Sachs, a staggering 99% of homeowners are locked into interest rates that fall below current market offerings. Digging a little bit deeper into these figures, 85% enjoy rates significantly under 5%, and a remarkable 63% have secured rates ranging from 2.5% to 4%. This scenario underlines the strategic calculation homeowners are making as they weigh the benefits of their current low-rate mortgages against the perspective of entering today's more expensive lending environments. Furthermore, Redfin's research highlighted that in cities such as Chicago, Atlanta, Los Angeles, and Washington, D.C., homeowners are enjoying rates below 3.5%, where significantly less inclined by 7.6% to list their home compared to those with rates above 3.5%. To illustrate the gravity of the situation, consider this. If a homeowner benefits from a 3% interest rate, housing prices would need to plummet nearly 36% for the identical property to match the same monthly payment under the current rates of 7%. For many, the mathematics of selling under these conditions fall to align with, not a good financial decision. When pondering the catalyst that might alter this landscape, analysis suggests that a drop in 30-year mortgage rates to about 5.5% could serve as a pivotal point, encouraging potential buyers to enter the market. However, the precise timing and likelihood of that shift remains subject to speculation and unfolding of economic dynamics. Additionally, as noteworthy as home values experiencing a downturn approximately a year ago, this was a period marked by amongst stagnant growth in home prices towards the end of 2022, primarily driven by apprehension surrounding escalating interest rates. This period of stagnation is partially responsible for the dramatic appreciation in home values observed in subsequent years, showcasing the intricate interplay between market sentiment and actual economic indicators. In essence, sellers found themselves tethered to their current homes, leading to a market slowdown due to the number of listings. This bottleneck meant the market had only one direction to move, and that's upwards. Regarding the region experiencing most substantial price surges, the suburbs emerged as the forefront in this rebound, whereas cities with historically high prices experienced a downturn largely attributed to dwindling affordability. Lastly, a significant development is the increasing of new home construction. This is a big one. In response to a pronounced housing shortage, builders have stepped up, now contributing one third, that's right, 33% of the market's inventory with new construction. This uptick in builder activity has breathed new life into the construction industry, which has witnessed a 21.7 surge in new building projects compared to just a year ago. So a 21.7 increase compared to last year. Yeah, as we look towards the future, the outlook has become somewhat murky. This sentiment stems from Warren Buffett's recent move to liquidate his investments at what many speculate to be the market's zenith. The decision begs the question, does Buffett have insight into the market dynamics that remains unknown to the wider public? This is where the plot thickens significantly. In August of 2023, Warren Buffett made headlines by disclosing a significant investment in three major U.S. home builders, D.R. Horton, Lennar, and VR. These companies are renowned for their focus on constructing single-family homes across the United States, collectively accounting for nearly 170,000 new constructions annually. At the moment of acquisition, these values shared stood around $800 million. Before Buffett's investment, stocks in these home builder sectors were already surpassing the S&P 500 by a considerable margin, with D.R. Horton at the forefront of this success. Today, the scenario is markedly different, and positively so. Since Warren Buffett's acquisition, D.R. Horton's value has surged by 35%, Lennar by 30%, and NVR by 20%, all within the span of just 7 months. This impressive performance allowed for Warren Buffett to realize a profit of $250 million from just one of these stocks in a mere 7 months. Home builders possess a distinct advantage over individual homeowners, notably in the realm of terms. Owing to their generally stable profit margins on sales, mass builders can afford to offer enticing incentives to prospective buyers. These incentives range from reduced mortgage rates and providing cash back at closing to even offering free additional upgrades or even price cuts for transactions concluded by a specified date. For instance, D.R. Horton has indicated that their most effective promotional strategy has been offering of interest rate buy downs. Typically, they offer a point below market rate on a 30-year fixed rate mortgage for the entirety of the loan. To put it simply, if the mortgage rates stand at 6.2, they could reduce your rate to 5.2, leading to a significant saving over time. Additionally, during periods of housing shortages, many buyers have limited options but to turn to these home builders. The scarcity of these alternatives have driven up demand, boosting the builders' profits and subsequently their stock prices. This in turn raises a question. Why would Warren Buffett decide to divest from a stock that he typically holds for extended periods of time? At this juncture, the reality is that we're in the dark about what to expect and the rationale behind Warren Buffett's decision. Some speculate that the rapid rally in homebuilder stocks have presented an opportune moment for Buffett to secure his gains, which explains his exit. Alternatively, there's a theory suggesting that Buffett had turned bearish on the housing market, viewing it as a concerning signal. On a personal note, it's intriguing to consider Buffett's candid admission to Newswork, where he tempered the expectations about Berkshire Hathaway's future performance. While this outlook might cast a shadow over the housing market and home builders' futures, it's important to contextualize Berkshire Hathaway's position. Currently, the conglomerate holds a $168 billion in cash, making its home building investment a mere drop in the bucket, equating to roughly about 0.6% in its total cash reserves. To put it into perspective, this is equal to someone with $100,000 in savings deciding to save or invest $700. Given the scale, it's hard to argue that there's anything particularly alarming about Warren Buffett's investment move. So, what would it genuinely take for the housing market to experience a downturn? As Ben Carlson suggests, the occurrence of a recession might not lead to a surge in sales, primarily because many homeowners have secured low mortgage rates and would be reluctant to sell. Additionally, 40% of homeowners are mortgage free, reducing the likelihood of mass panic driven sell offs. While an unforeseeable black swan event could always disrupt the market, such scenarios are inherently unpredictable. In what I consider one of the most insightful analysis, Mark Woodsworth in 2023 said that a decline in the housing prices would necessitate a significant drop in demand or a substantial increase in inventory. For prices to align with historical norms, demand would need to be in health, a scenario Woodworth deems improbable, given that transaction volumes haven't dropped below 2 million since the early 1980s. On the other hand, a doubling of housing supply could theoretically trigger a pricing correction, although this would probably require time to materialize, and I highly doubt there's going to be a mass sell-off, as we talked about earlier. Woodworth elaborates that an influx of properties onto the market could stem from individuals, investors deciding to sell the ratio of market price to rental incomes become increasingly favorable. This could also apply to Airbnb owners or speculative real estate investors, especially as more rental properties are built and more homeowners opt to rent out their properties, potentially diminishing market returns. Yet these are speculative outcomes, and the market could just simply continue to move in an upward trajectory. So there you guys go. Leave a comment down below. Send me a message. I want to hear your opinions on what's going to happen this next coming year. Until next time, Joel with Real Broker.